Welcome to the Explainer. Today, we are going to build a complete framework for investing. Now, this isn't about chasing hot stock tips or trying to time the market. No, this is about creating a durable, repeatable system for making smart decisions. Decisions based on clear criteria, not just a gut feeling. We're going to construct the 4 essential pillars that can support a lifetime of successful investing.
But, before we can build anything, we have to start with the most fundamental question of all. When you put your hard-earned money into an asset, whether it's a stock, a piece of real estate, you name it, what is the actual goal? What are you really trying to do? Because the answer to this question, well, it isn't as obvious as it seems, and it reveals 2 completely different philosophies about how money and wealth actually work.
So, here's our game plan. We'll kick things off by defining those 2 core goals I just mentioned, capital gains versus cash flow. Then, we'll build our system pillar by pillar. We'll start with how to find an asset's true value, then how to read the market's trends, how to create real income from your assets, and finally, how to manage your risk. By the end, you'll see exactly how these pieces lock together to form a complete, cohesive investing system. All right, let's dive in.
Okay, so every single investment you could possibly make has 2 sides to it, kind of like 2 faces of the same coin. And here's the thing, most people only ever look at one side. But understanding and using both is the absolute key to building real, sustainable wealth. These are the 2 paths every investor can choose to walk down.
The first path, capital gains, is the one you hear about all the time, right? It's the excitement of buying a stock at $10 and selling it at 20. You're essentially betting that someone in the future is going to value it more than you do today. But the second path, the one that's often overlooked, is cash flow. Here, the goal isn't really to sell. It's to own assets that put money in your pocket month after month, like a rental property that gives you a rent check, no matter what the property's market price is doing.
Now, here's what's so incredibly important about this slide. This idea of control. Think about it. You can't personally make the stock market go up. You can't force a housing market to boom. Those prices are driven by millions of other people and a million different factors. But the income an asset generates, that's something you have a whole lot of influence over. You can improve a property to get higher rent. You can pick stocks that have a long history of paying reliable dividends. That element of control, well, it's an absolute game changer.
So let's move to our first pillar, which is really the foundation of any sound investment. This is all about learning to see the difference between an asset's price tag and its actual underlying worth. It's about becoming a detective, not just a speculator.
This one sentence from Warren Buffett is the bedrock of his entire multi-billion-dollar fortune. It's such a simple idea, but it's so powerful. Price is just a number, flickering on a screen, and it's driven by emotions, by fear, by greed. But value is what the business is actually worth. Its assets, its brand, its power to earn money. A true investor knows that these 2 things are very rarely the same.
And the tool for doing this is called fundamental analysis. All it really means is that you stop staring at the stock price and you start investigating the business itself. You start asking the important questions. Is this company actually profitable? How much debt is it carrying? Are its sales growing consistently? You're basically becoming a financial detective digging into its books to find out how healthy it really is, just like a bank would before giving out a huge loan.
So this all boils down to a simple 3-step process. Step 1, you do your homework and figure out a company's true value. Let's say your analysis shows it's really worth about $40 a share. Step 2, you check the market price. What's it selling for today? Whoa, it's only $30. So you move to step 3. You buy it with a buffer. That $10 gap between its value and its price, that is your margin of safety. It's your built-in cushion against being wrong, and it's the secret to buying great companies at a discount.
Okay, so now that we know how to figure out what to buy, a quality asset at a good price, our second pillar helps us understand when to buy. This is where we learn to read the collective mood, the story of the market.
And this is called technical analysis. And let's be super clear, this is not about predicting the future with a crystal ball. A stock chart is simply a picture, a story of supply and demand. When there are more buyers than sellers, the price goes up. When sellers are in control, it falls. Technical analysis is simply the skill of studying these charts to see those patterns and understand the market's current momentum. At its core, it's about identifying the market's main direction, its trend. So an uptrend is just a series of higher peaks and higher valleys. The price moves up, it pulls back a little but not as low as before, and then it shoots up to a new higher peak. A downtrend is just the exact opposite, lower peaks and lower valleys. The whole goal here is to invest in harmony with the market, because like they say, a rising tide lifts all boats.
Now, let's see how all this builds to the third pillar, which brings us right back to that powerful idea we started with, cash flow. This is where you really shift your mindset from just hoping for a price increase to actively engineering an income stream for yourself.
And this comparison just illustrates the difference perfectly. Your typical 401k is completely tied to capital gains. Your wealth is on a roller coaster, going up and down with the mood of the market. Now just imagine a real estate investor back in the 2008 crash. The value of their property on paper might have tanked, say 30%. Wrecked their net worth, right? But what happened to the rent check? For a good property with a good tenant, it just kept coming in, month after month after month. Their cash flow stayed steady even while the asset's value was collapsing. That is the power of this pillar.
This brings us to our final, and maybe the most crucial pillar of the whole structure. Because let's be honest, all investing involves risk. There are no guarantees. The difference between amateurs and professionals is that professionals have a system for managing that risk.
Look, even the absolute best investors in the world are wrong sometimes. They buy stocks that go down, they back projects that fail. The reason they succeed over the long haul isn't because they have a perfect track record. It's because they have a plan to make sure their losses are small and their winners are big. Risk management is really the foundation of profitable investing.
A key tool for this is the reward-to-risk ratio. So before you even think about buying, you define what a win looks like and what a loss looks like. A common rule of thumb is to only take trades where your potential profit is at least 3 times bigger than your potential loss. This way, you can actually be wrong more than half the time and still come out ahead. Think about it. If you win 5 times and make $3 each, that's 15 bucks. If you lose 5 times and lose $1 each, that's a $5 loss. You still end up with a $10 profit, even with a 50% win rate.
This whole thing is built on a few non-negotiable rules. First, position sizing. You decide up front the absolute maximum you are willing to lose on this one idea. Second, and this is so critical, you have to know your exit point for a loss before you ever click the buy button. If you don't know where you'll get out if you're wrong, you have no idea how much you're actually risking. And finally, you have to stick to the plan. The market will mess with your emotions. A system is what protects you from making dumb decisions based on fear or greed.
So, we've built our 4 pillars. We've got value, trends, income, and risk management. But how do they all work together? How do they create a single, powerful structure for making all your investment decisions?
Well, together they form a complete decision-making filter. Pillar 1 tells you what to buy, a quality, undervalued asset. Pillar 2 tells you when to buy, when the overall market trend is on your side. Pillar 3 defines how you're going to profit by generating income. And Pillar 4 shows you how to protect your capital with a built-in safety net. You see? This is how you move from chaotic guesswork and hot tips to a calm, repeatable system.
The single most important takeaway here is that successful long-term investing isn't about finding some magic bullet or the next big thing. It's about building a robust system that fits you and your goals. We've just laid out the blueprint for you. So now, the only question left is, which one of these pillars are you going to start building first?